All right, welcome back to StoxCompare, where we literally tear apart the SEC filings so you don't have to. Today, we're diving deep into a company that is completely splitting the retail investing community right down the middle right now. I'm talking about Instacart, ticker symbol CART. So is this grocery delivery giant a massive cash cow secretly gearing up for its next huge run? Or is it just a classic value trap waiting to burn your portfolio? Well, we're going to look strictly at the hard data to find out. Let's get into it.
Section 1, the Instacart Growth Paradox.
So here is the absolute central mystery of today's explainer. If you bought Instacart a year ago, you are probably incredibly frustrated right now. The one-year return is a completely flat plus 0.79%. I mean, it has been totally range-bound. But when we zoom out to a 5-year horizon, it is a completely different story. Over that longer time frame, this stock has seen a massive, mountain-like expansion, up a staggering 61.30%. The market clearly cannot make up its mind about what phase of life Instacart is actually in right now. Now, before we crack open the financials to solve this mystery, make sure you hit that subscribe button to StoxCompare so you never miss another data-bagged deep dive.
Section 2, top-line revenue cooling.
To really understand why the stock has just flatlined over the last 12 months, we've got to look at the revenue. And honestly, the top line actually looks great at first glance. They've doubled their sales since 2021, pulling in a seriously impressive $3.74 billion in 2025. But underlying that top-line number, their year-over-year growth rate is actively decelerating. It's dropping fast. So what does this mean for retail investors like us? It means the hyper-growth startup phase is officially dead. Instacart is rapidly maturing into a completely different kind of beast, and the broader market is still trying to figure out how to price in that new reality.
Section 3, profitability pivot and cash. Okay, so if top-line growth is cooling off, how on earth did the stock manage that massive 60% 5-year run-up? Well, it all comes down to a dramatic bottom-line transformation. Guys, this is the story of a company fighting for its life and actually winning. Back in 2023, Instacart was trapped in what we call the Valley of Death. They were just bleeding cash, posting a net loss of $1.62 billion with absolutely brutal negative margins. But then, management completely flipped a switch. They abandoned that old grow-at-all-costs startup mentality and skyrocketed out of that valley by 2025 to achieve a highly stabilized 73.7% gross margin, bringing in over $450 million in pure profit.
Now, this margin recovery wasn't magic, right? And it certainly wasn't because everyone suddenly started buying twice as many groceries. No, it was a ruthless masterclass in operational discipline. Back during that 2023 crisis, research and development alone was eating up a massive 76% of their revenue. That is unsustainable. So management took an absolute chainsaw to their operating expenses. By 2025, they slashed R&D down to an incredibly lean 17.3% and aggressively cut their SG&A down to 35.7%. This super aggressive cost-cutting is the direct fuel behind their massive swing back to profitability.
But listen, here is where the story gets really exciting, and this brilliantly illustrates the true investment thesis for Cart right now. If you only look at their reported net income of $456 million, you are completely missing the hidden engine of this company. When you add back non-cash items and depreciation, you realize that their actual cash generation is double the reported accounting profit. Instacart is a cash-generating monster, printing a staggering $910 million in cold, hard, free cash flow. That is the exact metric that should have every single value investor paying very close attention.
Section 4, Fortress Balance Sheet and Buybacks. Generating almost $1 billion in free cash flow is amazing for sure, but as investors, we need to know exactly how management is utilizing that cash. What we're dealing with here is a financial fortress. Bankruptcy risk for this company is practically non-existent. They are sitting on a microscopic $36 million in debt, giving them a practically zero debt-to-equity profile. And on top of that, their liquidity is just off the charts, boasting an elite 2.398x working capital ratio. This balance sheet is absolutely bulletproof, meaning Instacart can weather almost any macroeconomic storm or high interest rate environment the market tries to throw at them. Now, before we talk about exactly what management is doing with this literal fortress of cash, I want you to drop a comment down below. What are your personal thoughts on Cart stock right now? Are you buying, are you holding, or are you selling? Let us know. Because what management is doing is incredibly aggressive. They aren't paying a dividend. They're spending barely anything on capital expenditures. Instead, they went on an absolute buyback binge, allocating a massive $1.378 billion to relentlessly eat their own float in 2025. They are loudly signaling to the market that they firmly believe their own stock is deeply, deeply undervalued. But is it actually still undervalued? Let's do a quick valuation reality check. Since they escaped the valley of death, the stock has definitely gotten more expensive. The price-to-book multiple has expanded significantly, jumping from a heavily discounted 1.75x in 2023 all the way up to a 4.69x premium today. However, here is the absolutely crucial trade-off. Yes, you are paying a higher multiple now, but you are buying into a fundamentally superior, highly efficient business. Because of their aggressive capital returns, they are now generating an absolutely elite 38.4% return on invested capital. You are paying a premium, sure, but you are paying for high-tier quality.
Section 5. The bear case risks.
Of course, every investment has a downside, and we have to objectively look at the risks associated with this level of financial engineering. The primary risk staring us right in the face is the shrinking war chest. This aggressive billion-dollar buyback strategy comes at a very real cost to their liquidity buffer. Total cash and cash equivalents have plummeted from a very comfortable $2.3 billion in 2023 down to just under $900 million today. When you combine this rapid depletion of cash reserves with the slowing top-line revenue growth we looked at earlier, you have to ask a serious question. How long can management actually sustain the stock price through pure financial engineering without genuine organic market expansion?
Section 6. Final verdict. Hold or buy?
So we've looked at the stalling revenue, the incredible operational turnaround, the massive free cash flow, and the aggressive buyback risks. Here is the final StoxCompare verdict. Instacart is a strong hold and a strategic accumulate on major dips. The thesis here is crystal clear. This company has successfully and permanently transitioned from a cash-burning hypergrowth tech startup into a mature, cash-printing value stock. If you were looking for a speculative rocket ship to double your money overnight, you gotta look elsewhere. But if you want a deeply profitable, virtually debt-free cash cow that is generating almost $1 billion in free cash flow and relentlessly buying up its own shares, CART is incredibly compelling. The provocative question you have to leave with today is this: once they finally finish eating up their own float, what massive move will they make next? Thanks so much for tuning into this explainer. Make sure you hit subscribe, and we'll see you in the next deep dive.